Most people are leaving tens, sometimes hundreds of thousands of dollars on the table just because they don't understand how retirement accounts really work. Roth IRA, 401k, traditional IRA. Guess what? They're not all the same. And if you're not coordinating them correctly, you're missing out on major tax breaks and putting your future at risk. In this episode, I'm going to demystify all of it. I'll show you how much you can actually save, how to avoid the penalties, and how to build a smart, flexible retirement plan, whether you're in your 20s or your 60s. And I've got a bonus, a powerful strategy that high earners love, but most advisors, they never even mention it. Let's get into it. In over 30 years of wealth management and retirement planning, I hear this question almost every day. How much can I actually put into these accounts? And more importantly, can they work together? Here's the breakdown. For 2025, for a 401k, 403b, or a thrift savings plan, you can contribute up to $23,500. And if you're over 50 years old, you can get an extra $7,500 in that account. That's a total of $31,000 per year. And this doesn't include your employer match. That's extra. Traditional IRA and Roth IRA, how about those? You're allowed $7,000 total or $8,000 if you're over 50. Here's a key point that people miss. The $7,000 limit is shared between that Roth and the traditional IRA. You can split your contributions between the two, but you can't double dip. Here's an example. You could put $4,000 into the Roth IRA and the other $3,000 into a traditional IRA. But good news, your 401k limits are separate from those IRA limits. So yes, you can max both in the same year. That's up to $30,500 total if you're under 50, even more if you're over 50. And here's a quick tip. A lot of folks think they're not eligible for the IRA if they have a 401k. And that's just not true. You can contribute to both. It's just the deductibility that changes based on your income. I'll explain more on that in another video. Now, let's talk taxes, because this is where most people either win really big or they get blindsided during retirement. Here's a simple way to think about it. Use your 401k or traditional IRA for pre-tax savings, and that means you get a tax deduction now. Lowers your current taxable income, and you pay taxes later when you withdraw that money. Use Roth IRAs or Roth 401ks for after-tax savings, meaning you pay tax now, but your money grows tax-free and your withdrawals are tax-free in retirement. So which is better? It depends on your tax bracket, now and in the future. If you're in a high bracket today and you think you'll be in a lower one later, pre-tax savings is going to make more sense. But if you believe taxes are only going up or you're early in your career, Roth might be the better move. Pay the tax now and you never pay it again. I like to see people mix these contributions. That's called good tax diversification, and it matters when you start taking that income from all of these accounts during retirement. You're spreading your money across different tax buckets, some pre-tax, some Roth, maybe even some post-tax brokerage. That's going to give you more control later, and it can protect your retirement from those potential future tax hikes. Let me give you an example. Imagine someone with $2 million in a pre-tax 401k, but no Roth accounts. Once they hit their 70s and start being forced to take those RMDs or required minimum distributions, they could be forced to withdraw up to $100,000 a year. That could push them into a higher tax bracket and maybe even raise their Medicare premiums. That's why thinking about your tax planning now, not just how much you save, is a real game changer. A smart mix of accounts, it really gives you flexibility when you're going to need it the most. Now, let's talk about the strategy almost no one is using, and it could change your entire approach if you're a high earner. Let's say you make too much to contribute to a Roth IRA directly. You're phased out. End of story, right? Wrong. That's where the Backdoor Roth IRA comes in, and here's how it works. You make a non-deductible contribution to your traditional IRA and then immediately convert it to a Roth. No income limits, no penalty, just a smart strategy. And yes, it's perfectly legal when done correctly. The key is to convert quickly to avoid any tax on the growth. But it gets better. If your 401k allows after-tax contributions, and many large employers or even solo 401k plans do, you can use something called the Mega Backdoor Roth. In 2025, The total 401k contribution limit, including employee, employer, and after-tax contributions, is around $70,000. And if you're over 50, it's closer to $80,000. So here's what you do. You max your regular 401k contributions. Then you make after-tax contributions up to that $70,000 total. Then roll these after-tax dollars into a Roth 401k or Roth IRA. This is how some high-income savers are putting almost six figures into Roth buckets every year without breaking a single rule. Most advisors don't talk about this because they either don't understand it or their firm doesn't offer a plan that supports it. But if yours does, or you're self-employed with a solo 401k plan, you've got a huge opportunity here. Now, let's shift gears to a few powerful accounts that most people overlook. Some of these could completely change your retirement math. First, the Health Savings Account, or HSA. This one gives you a triple tax advantage. You get tax deduction when you contribute, it grows tax-free, and it's tax-free on the distribution if used for qualified medical expenses. Think of it like a supercharged Roth for healthcare. And yes, it could even be more powerful than your 401k plan in some instances. Next up, it's the solo 401k plan, one of my favorites. If you're self-employed with no full-time employees, this is a no-brainer. You can contribute both as the employee and the employer, potentially putting more than $80,000 per year into your retirement plan. And yes, if the plan allows those after-tax contributions that we talked about, you can even stack this with the mega backdoor. That's huge potential. Now, 457B plans. If you work for a government or certain nonprofit employers, don't overlook this one. You can contribute the same limits as you could in a 401k plan, and in some cases, you can do it in addition to a 403B or 401k. Now, for the advanced players, got something really special, the cash balance plan. If you're a high-income business owner, this could be your secret weapon. It's technically a defined benefit plan, like a pension, but it looks and feels like a 401k or an IRA. The best part? Huge contribution limits. We're talking $100,000, $200,000 or more per year pre-tax. It's perfect if you're trying to catch up fast, or if you really want to lower your taxable income in a big way. And it comes with an added bonus, creditor protection, just like your 401k and some of these other accounts. And that's a big deal for you business owners and high net worth investors. Now, if you're in your 50s or 60s, you're behind on savings, or want to lower your tax, believe me, the cash balance plan, game changer. Let's wrap this up with a quick breakdown by age group, because your strategy should change as you do. In your 20s and 30s, I want you to prioritize Roth contributions, maximize compound growth, and avoid lifestyle creep. This is your launch pad. Even small contributions can snowball into massive balances over time. If you're in your 40s and 50s, max your contributions, layer in tax diversification, and consider the backdoor and the mega backdoor Roth strategies. You're likely in your highest earning years during this age group, so take advantage of every tax break available. And if you're in your 60s or beyond, you got to focus on distribution planning. You're almost there. So prepare for RMDs, or required minimum distributions, and optimize your tax brackets and legacy goals. This is where cash balance plan can really shine, especially if you need to catch up fast and lower taxes. And remember, taxes don't stop in retirement. If you don't plan your withdrawals carefully, they can wreck your income planning in retirement. Here's my last tip. Most retirement advice is focused on accumulation, but the smartest savers, they're planning how they'll spend it too, and they're planning for those ugly taxes. I can promise you this, you don't want a retirement that's full of tax surprises. Now, if you found this helpful, hit that like button and subscribe to our channel, because we're really just getting started. Drop a comment with your age group, and I'll reply with a tip that's tailored to where you are in your journey. And if all this still feels confusing, it's not your fault. This system wasn't designed to be easy. That's why I'm here to help make it clear. Now, in this next video, it reveals a $33,000 retirement planning mistake and how to avoid it. Click or tap that screen to watch it now.